The average retirement savings revealed. Are you normal? I don't like doing these kind of videos because they are clickbait, but there's something in here I have got to talk about because it's funny, man. When I say clickbait, it's like it matters not what this guy down the street has relative to what I have. But people like it, so it gets views, but I want to show you what's actually kind of funny in here and how we're manipulated. No other way around that. So check this out. So here these guys are. They're happy. I don't say any kids, dude. We need some children running around there. All right, let's pump them out so we can get Social Security. So we're going to go down here, and we're going to go to right here. Hold on just a second. American average retirement savings by age, October 2020. Center for Retirement Research says this is 401ks and IRAs. And I absolutely somewhat agree with this. I don't take issue with the way they got their numbers, the Center for Retirement Research. I think that's probably pretty close. Now, I will share with you something that still makes me somewhat suspect, but we'll go with it. 55 to 64, 45 to 90, 54. All right, so if you're 45 to 54, you have about $100,000. If you're 55 to 64, you have 120. That's the average. It's not the median. And they got that from looking at this from the Center for Retirement Research over here. And I just did a video on this not too long ago. So let's open that puppy up and we'll go with it. All right, so I don't have a huge qualm with that, but I did find it interesting. I want to show you guys something here. Check this out. There are $11 trillion in IRA money compared to $7.4 trillion in 401ks. You know, that's about $18.5 trillion in deferred money. I shouldn't say deferred because some of that might be Roth. Be that as it may, that's a lot of freaking money, dudes. You know what I'm saying? So that's where I challenge it. I haven't done the research here that much. I didn't take the time. But you could literally say, okay, if we got 19 trillion in IRA money, how many people are above the age of 50? You know what I'm saying? And divide that into the 19 trillion. I don't know what it is. I just find that interesting. That's a lot of money, dude. I mean, our GDP on the U.S. is what, 20 trillion? No, what's our GDP? 5 trillion? I can't remember. Anyway, that's a lot of money in retirement accounts. That's a fact. Jack. So I got no qualm with how they came up with that. And the way they do is they look at survey of consumer finances and they kind of get that gauge. So I got no qualm with that. What I did find was interesting is they said, how much should you have? So let's go in here. And they say, conclude right here. One interesting question is how much should you expect to have? And so if we take a guy 25 years old in 1984 with the median earnings who reaches 60. All right, so Barky McGee had to interrupt my thoughts, so I forgot exactly where he left off. But anyway, we'd take a guy who's 25 in 1984. Now he's 60 years old in 2019. He put 6% of his salary into a retirement account and received a 50% match with a 50-50 stock to bond allocation. That guy should have $425,000. All right, so that's not what he has. I mean, he doesn't have $425,000. He has. But calculations assumes continuous contributions, no fees, no leakage. Okay, whatever. He doesn't have $425,000. The median is he has right there $120,000, and that's between 55 and 64. So about basically $100,000 what this guy has. All right. So the point being is that he's well below where he should be relatively to what if he had 6% with a 3% match, all that. But okay, that's fine. I mean, we don't know. I mean, even with that $425,000, according to these people at the Retirement Research and all the other statistics that say, look, this is why the 401k has failed us because $425,000 at 5% still only gives you $20,000 a year. All right, so the facts are we are never had retirement in the history of the world until basically the last two generations. People worked until they died or they lived at home with their kids and grandkids. So the whole point is we don't know what is right or wrong. There's no right or wrong answer. I'm talking about how many people actually stay. And I hate using the median as if, what this guy should has as if this means something. I mean, if you look at my earnings history, dude, I was making a pittance up until about 2008. And I didn't break 100,000 until 2010. You know what I'm saying? And I've been at 100,000 every year since until the first year I started this business. But I mean, from 2000, when I started working, from 19 83 washing dishes until 2010. I didn't make hardly anything. And so, what is the median income? Why would you put a guy at 25 years old with a median income? Doesn't make sense. If you're 25, what do you say, 25 years old? Yeah, so you just got a college, whatever. I mean, he's not going to be making the median income at 25. You got to start someplace. I hope that makes sense. So, in of itself, I think it's interesting to look at. The median earnings for a guy who's 25. You'd have to look at the median earnings for a guy who's 25, not the median earnings for the entirety of the population. That's dumb. All right, be that as it may, let's keep going. Here we got you should have the equivalent of 1 year's salary by the time you hit 30, 3 by the time you hit 40, 6 by the time you hit 50. I'm nowhere near 6. And 8 times by the time you hit 60, with the hopes of saving 10 times when it's time to retire. How do they get that? These recommendations are based on a person saving 15% of their income beginning at the age of 25. Look, man, that's a lot. If you have no debt, you can do this. If you have debt and kids and whatnot, you're not going to be able to save 15%, most likely for the rest of your life. So that's just silly. Right here, and again, just more doom and gloom. The National Institute for Retirement Security, they push annuities. 40 million households have no retirement savings. Well, how are they classifying retirement savings? I've talked about this before. Are they just looking at defined benefits? Are they looking at 401ks? Are they looking at everything? And by the way, you can still have retirement savings in a brokerage account, which isn't considered retirement savings. It's stupid. I mean, if I have an M1 account, it's my retirement account. It's not an IRA. Is that considered retirement savings? For me, it is. For these guys, it's not. While the Employee Benefit Research Institute estimates that Americans have a savings deficit of $3.68 trillion. I thought that was CRR, actually, Center for Retirement Research. So I was surprised, pandemic. And we've talked about that as well. If you factor in how they're getting that, there's basically lots of it's silly on its face. And I'm not going to go revisit this in this video, but I want to show you some here. Shocking savings statistics. We have a deficit of $3.68 trillion. No, we don't. But this is what kind of cracked me up. How an advisor could help you increase your returns by basically double. Holy smokes! The value of working with an advisor. How are we getting that higher? This is just actually drives me up the wall. Assuming a 5% annual growth of $500,000 and 8% annualized versus an 8% annualized growth of an advisor managed portfolio. They're assuming you get 5% on your own and your advisor gets 8%. That's how your advisor can make you basically more than double your money. The hypothetical discuss a 5% rate of net return, 3% added value for professional financial advice. And that's not what the flippin' Vanguard article says. It actually ticks me off. So we're going to look at this right here. The Vanguard article does not say that the guy's going to give you 3% extra on your portfolio. It's so... And here it is from Vanguard. It drives me up the wall. We believe implementing the Vanguard's Alpha framework can add up to, even exceed 3% in net returns for your clients and help you differentiate your skills. Now, how did they get that, you're wondering? Well, let's take a gander. This is so freaking stupid. So in arguing that your financial advisor can do better, that's what the financial advisor is going to argue, than you could do it on your own, it is understandable that advisors would want a less abstract or subjective basis for their value. How did they do that? For advisors who promise better returns, I'm going to get you better returns on your portfolio than a benchmark. Well, we know it's not likely. In fact, the evidence of active fund managers is just, you're not going to do better after fees. So let's just put it that way. So indeed, so how do then advisors assume that they're going to outperform and give you the extra 3% that these guys are just talking about? So let's check this out. So we're going to get the biggest one right here: behavioral coaching, keeping you from making your big mistake. I absolutely hate this argument. This is where they're saying the 3%. Vanguard is saying you could get basically of that 3% extra, you're going to get an advisor. Two-thirds of that is going to come from keeping you from doing something stupid, i.e. selling when the markets are down and buying when the markets are high. It's so, I mean, I don't know how this works here. And behavioral coaching, there used to be something called the doll bar study that said basically you're a horrible investor on your own because you do bad things. You're irrational. And they use that is real. I fell for it when I first heard it because I needed to justify my fees. And I was like, oh, that makes sense. I as an advisor will help you not make those mistakes. And then I started thinking, like, who are these people that make these mistakes? Who? I never came across them. Most people I talked to, they never paid much mind. They put the money in and they just let it go. I said, that's exactly how you do it as an investor. You don't look at, I have no idea what the markets are doing today, frankly. All right, none. And I don't want to know, because what good does it do for me to know what the markets are doing today? It doesn't do me any good. So I always wonder, like, who these people are that are making this big mistake. And, you'll see a couple guys on YouTube and stuff, and that's fine. There are some people out there, and how did they quantify that? And, well, the Dalbar study, they couldn't really. So Vanguard and Morningstar both came up with these studies that say we are showing that, but it was a very broad base, because where they're saying we are showing that investors underperform their funds by 1 percentage point or whatever it was. You're like, really? And you're going to make that a broad brush on the overall investment market that you, Mrs. Smith, will underperform your fund by 1%. It was always weird to me. I never liked that. And I just remember trying to make this argument, like looking at somebody say, yeah, man, if you don't have me, you're going to lose 1 to 2% returns because you're basically stupid. And it was such a bad argument. Now, the Dalbar studies nonsense. The Morningstar and Vanguard have studies that kind of go on the same lines, but I never quite could gauge, how they're figuring that out. And they do it in Money in Motion. And I still say, but Money in Motion, it's like people investing, people taking money out. They're doing it because their situation needs that for some reason. All right, whatever it is, man. And you're going to take these individual choices that people make, and you're going to throw it into this thing that say the average Morningstar fund averaged 8%, but the average investor only averaged 7% because of his cash movements, money motion. That didn't make any sense, especially when the guy who's taking money out might be needing it for a new car. He might be needing it because he's retired. A guy who's putting money in, the whole thing didn't make sense. And I still, to this day, don't like that, because I've never seen it in motion. Now, again, every now and again, you'll see some guy, I get emails like, should I sell? And I'm like, dude, you got to do what you got to do. But I don't think that's perpetual, or I don't think that's common in most investors. I just don't. And on top of that, the idea that I will stop you from making that big mistake. I'm telling you, man, if you're an advisor and this is your argument, yeah, you wait, dude. Wait till you tell some guy not to sell because the market's down 10% and then it drops another 15%. You have that, you're going to have a great conversation with somebody, let me tell you. And that's not a good place you want to be. I do like asset location. That's good. They say you can get 60 basis points from doing smart decisions on your allocation. I like that in terms of allocation, where you're putting various investments. I like that a lot. Rebalancing is easy. Cost effective, but that's stupid. Asset allocation, whatever. But this one right here is the spending strategy. Yes, I completely agree. If an advisor is engaged in proper spending strategy, he can return the portfolio. But I'm not sure 1.2% annually. And I certainly wouldn't use that to argue this right here. This is just freaking, it's insidious, man. This should not be allowed. I'm sorry. The idea my advisor can do that based on his Vanguard study, and when you look at it, it doesn't say your portfolio can. It's nuts. Anyway, it's net of taxes. I find it. I can't remember if Vanguard even includes the fees you got to pay. I don't remember, but I hope that helps. I know it's a little bit of a diatribe, but man, if you gotta scrape from the bottom of the barrel to validate your fees, you can't. Don't do that. Love your thoughts. We'll see you.